Today, I want to talk about how market makers are quite literally about to be margin called, as warned by the Bank for International Settlements and the current CEO protest. So stay tuned and let's make some money. And now I'll dive straight in with the key information. So, as Gold Telegraph tweeted, they said, breaking news. The Bank for International Settlements is warning that central clearinghouses that hold over $1 trillion in liquid assets may exacerbate periods of financial stress, saying this does not seem good. So first, let's clear up and clarify, both clearinghouses and market makers are the same thing. They're both designed to ensure the market flows smoothly and to ensure that settlement is made between two parties. They're effectively the intermediary or the market maker that glues the two parties together. If someone wants to buy and there's no shares available, that clearinghouse or market maker steps in to fill the order. And if somebody wants to sell and there's no buyers, the clearinghouse or market maker takes the other side of the trade. They're supposed to ensure that markets flow smoothly and flow fairly, but we all know that hasn't been happening. And now the Bank for International Settlements is warning that these large clearinghouses or market makers may exacerbate periods of financial stress. And the researchers also raised concerns over clearinghouses and their $600 billion of holdings in government bonds. And literally word for word, it says that margin calls from clearinghouses are seen stoking the future crisis. So the Bank for International Settlements is literally warning that if a clearinghouse or market maker gets margin called, that will cause a financial crisis. So for everyone that's going to jump into the comments and type clickbait, I've literally quoted this article word for word. So this article says that the use of a central clearinghouse or a market maker was seen as a fix after the 2008 crisis, but Bank for International Settlement researchers see a liquidity risk from margin call spirals. Effectively, if one of these market makers gets margin called, it will create a massive margin call spiral, crashing the price of all of these stocks, all of these securities, and crashing the market, making those margin calls even worse, and even worse. Saying clearinghouses or market makers that hold over $1 trillion in assets may exacerbate periods of financial stress, creating margin spirals that can push down asset prices. So literally exactly what I just explained. And if these market makers or clearinghouses increase initial margin requirements for its members or customers during these times of stress, this may lead to fire sales in equity and derivative markets. Because these investors dump assets to raise the needed funds for margin calls, increasing volatility further and triggering additional rounds of margin calls. Literally exactly what we've explained over the last 3 years and said would happen. When these shorts have to sell off their longs, it creates an even worse problem, crashing the market further, meaning they have to sell off more assets to meet margin calls until eventually they get liquidated and margin called as an entire fund, forced to sell off all long positions and close out of all short positions. Now you may be saying, now Tom, surely these margin calls are absolutely miles away. There's no chance any of these market makers could ever be margin called, and a market crash could surely never ever happen again in the future of the universe. Well, actually, you'd be wrong, because the top bosses of JP Morgan, Bank of America, Citigroup, Wells Fargo, and others are currently really worried about these margin requirements. And they're not just worried about margin requirements, but they're expected to warn lawmakers that capital hikes and other new regulations will hurt the economy and should be indefinitely shelved. And these top bosses aren't just going to warn these lawmakers about increased margin requirements, they're actually going to protest before Congress. These top bosses of JP Morgan, Citigroup, Bank of America, Wells Fargo, and others are literally refusing increased margin requirements. That's likely because these top bosses of these banks can't handle increased margin requirements, and if they were forced to post those increased margin requirements, they'd have to do exactly what that Bank of International Settlements article is warning of, and have a fire sale of assets to get the cash needed to meet margin requirements. So this margin calling of a market maker isn't a million miles away, never ever going to happen in our lifetime, it's actually right around the corner. So close, in fact, that these major bosses of top banks are going to protest before Congress. Also, I wanted to clear up some doubts you might have about the Millionaire Mindset Trading Group and explain why the group is good not just for you guys, but good for the AMC movement as a whole. So yesterday, as a prime example, JJ made $241. That's $241 that JJ wouldn't have had. He wouldn't have been able to earn it extra from his job. This is additional money JJ did not have before. So that's $241 of additional money that JJ could use to buy more AMC shares, buying an extra 32 shares in one day. On top of that, JJ also made money on Friday and on Thursday as well, potentially buying even more AMC shares. And that was nearly an extra $1,000 of AMC buying power that wouldn't have existed if it wasn't for the Millionaire Mindset Trading Group. And it's not just JJ. Keeley as well also made around $140 yesterday alone. These are real screenshots from real people, and we get profits like these in the group every single day. So if you want some more money, maybe to buy more AMC shares, maybe to treat yourself or a loved one for something nice, be sure to join the Millionaire Mindset Trading Group linked in the description below. And actually, these top bosses are trying their best with a fierce industry campaign to throw out margin requirements altogether. It says the CEOs are going to try and convince key moderate Democratic senators that the rules could stifle lending, hurting small businesses and consumers. Not that these banks could end up being margin called and closed down and liquidated. They're going to try and pin the blame on these regulators, saying it's hurting the average working American. Especially when we've literally had multiple banks collapse so far already this year. I don't think these margin requirements are going to be lowered. If anything, they're going to be increased, triggering these margin calls. So these big bank CEOs are currently stuck between a rock and a hard place. Right now, what the SEC is arguing is that we need increased margin requirements to try and stop things like Silicon Valley Bank from happening again. By increasing those margin requirements, it means the banks will be holding more cash and less susceptible to bank runs. But obviously, the problem being is that these banks don't have enough cash, and if they don't meet margin requirements, they will face margin calls. Which really is what you need to keep the economy safe. If someone's too over-leveraged, they're taking on too many losses and they're losing too much money, they really need to be margin called and shut down and liquidated. It gets incredibly risky, incredibly stupid, and incredibly damaging to the economy if these big banks are let off the hook from these margin calls when they're insolvent. But obviously what the bankers are trying to do, or what these big CEOs and market makers are trying to do, is push towards no margin requirements and no regulation whatsoever. Which really is how we ended up in the 2008 mess in the first place. If there's no margin requirements, no rules, no regulations, and no nothing, then these losses spiral out of control. And that's how you end up with incredibly damaging depression periods, financial crises, periods of inflation, and all of that mess as well. Really, it's much safer and better regulation-wise to push for more regulation, but obviously that ends up with the hedge funds and the market makers and these institutions being margin called. And as a sign to show really exactly where we are on the financial crisis timeline, check out this article from StockSense Frank. He tweeted this screenshot or this photo of Wells Fargo closing home equity lines of credit. Here it says the home equity line of credit, or HELOC, saying new home equity lines of credit are currently unavailable. Saying due to current market conditions, we're temporarily suspending new applications for HELOCs. This is obviously due to high interest rates, the property market struggling, and obviously these bankers foreseeing a financial crisis or at least a period of recession. You may say, well, Tom, maybe this happens all the time, maybe it's not much to worry about. But check out this article from 2008. Back in 2008, Citibank froze HELOCs in preparation for the recession. So Wells Fargo are doing the exact same thing Citibank did at the start of 2008. And finally, I also wanted to quickly talk about the meme stock basket and how when one meme stock squeezes, all of the stocks will squeeze alongside. Investor Turf tweeted saying GameStop concluded yesterday with a plus 10% closing, experiencing a 22% uptick in stock value over the past month. Short sellers are enduring substantial losses in the billions, and here's the top 10 hedge funds involved in shorting the GameStop stock. So you've got Susquehanna International, Sandler Capital Management, WS Management LLP, Simplex Trading, IMC Chicago, Jane Street, Pomelo Capital, Citadel Advisors, National Bank of Canada, and Group 1 Trading. Now tell me, how many of these hedge funds look familiar, and how many of these hedge funds are shorting AMC as well? We know Susquehanna, we know Simplex Trading, we know IMC Chicago, we know Jane Street, we know Citadel Advisors, and we know Group 1 Trading. All of these funds are all shorting AMC alongside GameStop. So when these hedge funds are struggling and being squeezed in GameStop, it's not just their GameStop position that will be squeezed. When the company or fund is liquidated, the entire fund is liquidated, meaning they don't just have to buy back their GameStop shares, they also have to buy back all of the AMC shares, causing the AMC squeeze alongside. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.